time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. Shopify Inc., Aaron, the e-commerce giant from Canada, precipitous loss in share value year to date, 72+%. We had a listener ask, with the drop, do you want me to read out the question or do you want to do it, Aaron?
Yeah, go ahead. Read out the question.
Yeah, I'd say I'm thinking about taking a position in Shopify. The stock is down tremendously over the past year in spite of continued revenue growth. What is your take on this company? Is it likely to recover? And does it represent good value at current price, Rob?
Right. So, Rob, thanks for the question. Happy to answer it. We get questions on Shopify all the time. Is it likely to recover? That's difficult to say. That really just depends on what happens with the market. Does it represent good value right now? The answer to that, I would say, is no, certainly not. So Shopify has been an incredible Canadian success story. What they are, they're an e-commerce business. They have an e-commerce platform that they provide to small and medium-sized businesses who are their customers. They have millions of these businesses throughout the world, in 175 companies that use their service. And it's about a $65 billion market cap right now, currently, after the decline, as Ryan said, down about 75%. But really, Shopify has been, it's been in the past the number one company in all of Canada. In the Canadian market, 65 billion even is quite a large market cap. But Shopify being categorized in the technology sector, I'd always said in the past, the Canadian technology sector is just way too underdeveloped, at least in the public markets. Typically, when I would take a look and compare it to the size of other sectors, it'd be about 5%. One day, one time I go on, I look and the technology sector in Canada is up at, 10 to 15, 12 to 15%. But then I realized that most of that was just one company. So it completely dwarfed the rest of the technology sector at its peak. It was the largest company in Canada, I believe, by market cap, larger than any of the banks. Now down 75%. Still a large company, but almost becoming a shadow of its former self, just in terms of its overall importance compared to some of the big banks like RBC and TD. What happened? Well, in many ways, Shopify really just is suffering from the same issues that a lot of technology companies are suffering from in North America, particularly in the United States. We've covered this in the past. The technology sector, technology software, or anything associated with high growth industries like e-commerce were going absolutely bananas for years. Valuations were up to unreal levels. Companies trading at upwards of 100 times sales. We would say 100 times earnings is extremely expensive. Many of these companies trading 100 times sales. And now many of these companies down 85, 95% even. So Shopify is one of these names, but not focusing on where the company's been in the past. We want to look at where is the company right now, and do we see an opportunity in the future? And for us, we don't really see an opportunity right now for Shopify. Doesn't mean that it can't recover to an extent over time. That really just depends on what happens with the markets, what happens with investor sentiment around higher risk or higher growth technology companies. But let's take a look at what the numbers are telling us right now. So the question identified that strong revenue growth has continued for Shopify, and it's down 75%. So does that not signify that there's some value in the stock? Well, that is true. Strong revenue growth has continued. So the company recently reported its Q3 2022 financial results. Revenue was up about 22% for the quarter. Now, 22%, that is a very strong, very legitimate growth rate. However, for Shopify, this is actually the second lowest growth rate that the company has reported in its history as a public company. And the growth rates for Shopify on a quarterly basis compared to the quarter of the previous year have been trending down. So that's something that we would look at with some caution. Trending down right now, as I said, 22% growth in the last quarter. But if we look at what the growth was a year before, in the third quarter of 2021, the quarterly growth rate was 96%. In the year before that, it was 45%. So for most of the company's history as a public stock, it's been around that 40 to 50% growth rate. So now it's come down. Now it's come down quite a bit. Now we would expect this. We would expect that a company will start to mature. It achieves these fantastic growth rates at some points. 100% revenue growth. That's not sustainable. So we would expect it to come down and mature. The problem that I'm seeing here with Shopify is, yes, the growth rate has come down in revenue, but they're continuing to lose a lot of money. They're not anywhere close to profitability. So what we would want to see from a company, I mean, if a company is producing an incredible high double-digit, low triple-digit growth rate, and they're investing so much of their money back into the business so that they can continue to grow, we understand that. And oftentimes this is going to result in the company reporting net losses. But now, clearly, the company looks like it's producing a more mature growth rate. So we would want to see signs that margins are improving, that the company is achieving profitability or in profitability and in the stage where they're actually growing their net profit and their cash flow. That is not the case with Shopify. In fact, relative to the previous year, they are losing more money now than they were in the past. Just pulling up like the 9-month figures, adjusted operating income, and this is adjusted as well, for the 9 months of 2022, negative 633 million, burning through almost 400 million in cash flow for the first 9 months of the year, burning through over 200 million in cash flow for the third quarter. So this isn't, we want to see once that revenue growth rate trends down, we want to see those margins start to trend up. And that's not what's happening here. In fact, what's happening is the exact opposite. So from just a purely financial perspective, in terms of, does this pass our financial tests of growth and profitability? It's far from. Now, I've looked at some analyst estimates for next year, and don't quote me on this because analyst estimates change frequently, but the consensus that I saw was about 4 or 5 cents per share next year in earnings. In earnings per share, that's in US dollars. Now, the company trades at $50. So if we were to look at this on a price to earnings basis, we could see that it is still an absolutely insane valuation relative to earnings. We really don't have any earnings though. So what does it look like relative to sales? So the price to sales ratio has come down a lot, as we would expect, since the stock is down about 75%. Right now, as of Q3, relative to sales, the company's trading at a price to sales ratio of about 9 times. So that's better. That's certainly far more reasonable than where we've seen it in its past, peaking at the high 40s to low 50s, an incredibly high price to sales valuation. And obviously at that time, the market analysts, investors who were buying the stock were looking at those high 50 to 100% revenue growth rates and extrapolating that going forward, which you really can't do. So now we're at what I would consider to be a more reasonable price to sales multiple, but really not that cheap. So 9 times sales, you're still looking more expensive than a company like Microsoft, still more expensive than a company like Google. It's been compared to Amazon a lot. The business has far more expensive on a price to sales multiple than Amazon, really just coming down to a price to sales level that we would consider maybe average for most software companies over an extended period of time, but by no means cheap. And you still have that issue of lack of profitability and a really high cash burn. So I say this company still has a lot to prove. I would not be buying it right now. Now, that does not mean that they can't turn the business around over the next couple of years. I understand it's a very interesting technology, very interesting platform, but I want to see evidence that they're actually able to operate at something near profitability. Because if that revenue growth rate continues to decline and they can't transition into profit, I don't think then we've seen the end of the share price decline. So we would step back. We would just be on the sidelines on this company. I just think that there are far better stocks in the technology space, in the SaaS and in the software space to buy right now that represent far better value and are actually producing profitability and cash flow. So you don't have that concern. So we're not buyers of Shopify.
Yeah, I think with a revenue growth rate of 20 to 25%, we're not going to pay 100 times next year's optimistic estimate for earnings. That's just it's down 75, it's down 85% in that range. And we keep hearing from clients. I heard this at a speech I gave in Toronto. Well, it must be cheap now. Well, Aaron just went through the numbers. Even on a price to sales basis, it might be just at an average multiple to the sector. And many of those companies with the price to sales in that range are actually cash flow positive. And, earnings not positive, and this company is not earnings positive right now. So, and they're spending a ton in terms of fulfillment over the course of this year to kind of catch up and be aligned with Amazon. Amazon certainly has more resources to spend more than them in this sector too. So,
yeah.
All right, let's get to or is there anything else?
I was just going to say, even when it was trading at its high flyer, prices, the amount of times that I heard, you, Ryan, and Aaron say this stock is priced to or above perfection. Once you see, or if you see that growth rate pull back, the stock can get decimated. That's, a similar story that you guys have seen in your career.
Yeah. And it's been absolutely decimated. And the thing is, it's been absolutely decimated, and we still don't think it offers anything close to reasonable price based on current underlying fundamentals.